Imagine a bomb. Not a physical weapon encased in steel, but a digital one, woven into the very code of the global financial system. It is ticking right now, hidden beneath the surface of the stock market tickers you see on the news, hidden in the back offices of banks too big to fail, hidden in plain sight. The explosive yield of this bomb is not measured in megatons. It is measured in dollars. $600 trillion. That is a 6 followed by 14 zeros. It's a number so large the human brain cannot truly comprehend it. To give you perspective, the entire global economy, everything produced by every country on Earth in a single year, is about $100 trillion. This bomb is 6 times larger than the entire world's economic output. It is called the derivatives market. And when it blows, and it will blow, it won't just be a recession. It won't just be a depression. It will be a systemic reset of the entire financial architecture of the modern world. We are told that 2008 was a once-in-a-lifetime crisis. We were told the system was fixed. Regulations were passed. Banks were stress-tested. We were lied to. The system wasn't fixed. The cracks were just papered over with cheap debt and central bank printing. And in the shadows, while everyone was distracted by politics and pandemics, the core problem didn't just survive. It metastasized. It grew bigger, faster, and deadlier. Today, the financial system is walking on a tightrope over a canyon of debt. And the derivatives market is a gust of wind waiting to happen. This isn't doom-mongering. This is cold, hard arithmetic. Before we descend into this financial abyss, I need you to do something. If you believe that understanding the harsh realities of the system is better than blissful ignorance, if you want to be prepared rather than blindsided when the next crisis hits, hit the subscribe button and turn on notifications. And in the comments below, answer me this. Do you trust the current financial system to protect your future, or do you feel like you're playing a rigged game? Let me know your thoughts. Now, let's examine the fuse. Most people remember 2008 as a housing crisis. Greedy bankers giving mortgages to people who couldn't afford them. That's the simple story. The comfortable story. But housing was just the trigger. The dynamite that blew up Lehman Brothers and Bear Stearns wasn't the mortgages themselves. It was the bets placed on those mortgages. They took a boring, stable asset, a house, and turned it into a global casino chip. They sliced them up, packaged them, and then sold insurance contracts on whether those packages would fail. Those contracts were derivatives. When the housing market sneezed, the derivatives market caught pneumonia. And because all the major banks were betting against each other, they all got sick at the same time. The world stared into the abyss in September 2008. ATMs were hours away from running dry. Global trade almost ground to a halt. It took trillions of taxpayer dollars and unprecedented central bank intervention to pull us back from the edge. We survived. Barely. But here is the terrifying truth that mainstream finance media will not tell you. The conditions today aren't just similar to 2008. They are exponentially worse. The leverage is higher. The players are more reckless. And the central banks are out of ammunition. We are facing a 7-headed hydra of risk that makes the 2008 housing bubble look like a minor accounting error. To understand why the next crash will be terminal to the current system, we have to peel back the layers of complexity designed to keep you in the dark. Section 1. The casino of everything. What exactly is a derivative? At its core, it's deceptively simple. It is a contract between two parties. Its value is derived from something else. An underlying asset. That asset could be anything. A stock, a bond, the price of oil, the exchange rate between the dollar and the yen, even the weather. Originally, derivatives had a noble purpose. They were used for hedging, for insurance. A farmer growing corn faces a risk that the price of corn will drop before harvest. He buys a derivative contract that pays him if the price falls. He locks in a price. He is stable. An airline worries about the price of jet fuel spiking. They buy a derivative to lock in their fuel costs for next year. This is healthy. This stabilizes the economy. But that's not what the $600 trillion market is today. Over the last 30 years, Wall Street realized something. You don't have to own the corn to bet on the price of corn. You don't need to own an airline to bet on jet fuel. You don't need to own a bond to bet on whether a country will default on its debt. Derivatives shifted from being insurance policies for producers to being pure gambling chips for speculators. Imagine a casino where you aren't just betting on red or black at the roulette table. You are betting on the outcome of someone else's bet. And someone else is betting on your bet on their bet. Layers upon layers of speculation. None of it tied to real productive activity. It's a hall of mirrors where real value is lost, and only phantom value remains. Today, the vast majority of derivatives are not used by farmers or airlines. They are used by hedge funds, investment banks, and high-frequency trading firms. They are used to make massive, levered bets on the direction of markets. They have turned the global financial system into the world's largest, most unregulated casino. And unlike a real casino, where the house has limits, the bets are theoretically infinite. But the money to pay them off is very real. And when the bets go bad, they don't just lose their chips. They burn down the casino. Section 2. The Shadow World. Where does a $600 trillion market hide? Surely something that big must be traded on a major exchange like the New York Stock Exchange. Right? Wrong. If you buy a stock, say Apple, that trade goes through a centralized exchange. It's transparent. Regulators can see it. The price is public. There are rules to ensure the person selling the stock actually has it. And the person buying it has the money. The vast majority of derivatives are not traded this way. They are traded over the counter, or OTC. This sounds benign, almost like buying medicine at a pharmacy. It is anything but. OTC means it's a private deal between two institutions. Bank A calls up hedge fund B and says, I want to bet $1 billion that interest rates will go down. Hedge fund B says, you're on. They sign a contract. A derivative is born. Nobody else sees this contract. Regulators don't get a real-time feed of these deals. There is no central clearinghouse guaranteeing the trade in many cases. It's a handshake deal made in the dark between giants. This is the shadow banking system, a parallel financial universe that operates outside the traditional rules and safety nets. In 2008, when Lehman Brothers collapsed, nobody knew who owed what to whom, because all the deals were OTC derivatives. Bank of America didn't know if their trading partners were exposed to Lehman. Trust evaporated instantly. Banks stopped lending to each other because they were terrified the other guy was secretly bankrupt from bad derivative bets. The credit markets froze. The lifeblood of the economy stopped flowing. Today, despite some feeble attempts at reform, the shadow world is bigger than ever. Trillions of dollars in high-stakes bets are happening right now, out of sight. We only see the tip of the iceberg. The regulators are bringing a flashlight to search a black hole. They don't know the true extent of the leverage until something breaks. And by then, it is always too late. Section 3. The Leverage Trap. This is the fuel that turns a spark into an inferno. Leverage is the use of borrowed money to amplify potential returns. In the derivatives world, leverage is everything. It's what allows these numbers to get so astronomically high. Let's say you want to buy $100,000 worth of actual stock. You generally need to put up at least $50,000 of your own money. That's 2-to-1 leverage. Risky, but manageable. In the derivatives market, the leverage ratios are insane. You might only need to put up 1% or 2% of the contract value, sometimes even less. This is called the margin. To control a $100 million position in derivatives, a bank might only need to put up $1 million in actual cash. That's 100 2, 1 leverage. It sounds great when things are going your way. If that $100 million position goes up by just 1%, you've made $1 million profit. You just doubled your money on a 1% move. That's the drug Wall Street is addicted to. But leverage cuts both ways. And it cuts deep. If that position drops by just 1%, your entire $1 million stake is wiped out instantly. Gone. But it gets worse. If it drops by 2%, you now owe another $1 million that you don't have. This is a margin call. The entity holding the other side of the bet demands you post more cash immediately to cover the losses. If you don't have the cash, you have to sell assets. You sell stocks. You sell bonds. You sell anything that isn't nailed down to raise cash. Now imagine this happening not just to one trader, but to the entire system at once. Everyone gets a margin call simultaneously because a major market moved against them. Suddenly, everyone is selling everything. Stock prices crash. Bond yields spike. The selling begets more selling. It becomes a death spiral. This is exactly what happened in March 2020 during the pandemic onset. The markets went into freefall not just because of the virus, but because highly levered hedge funds were hit with massive margin calls. The Federal Reserve had to step in with trillions of dollars of liquidity to stop the bleeding. They bailed out the gamblers. But the gamblers didn't learn their lesson. They just took the free money and made bigger bets. The $600 trillion figure you hear is the notional value of derivatives. Critics often argue, oh, that's just the face value of the contracts. The real money at risk is much smaller. This is a dangerous half-truth. Yes. The actual cash changing hands today is smaller. But the notional value represents the potential exposure if things go terribly wrong. It represents the size of the avalanche waiting to fall. With leverage ratios at historic highs, a small move in the underlying assets can trigger losses that exceed the total capital of the world's biggest banks. They are betting the house, the car, and their future earnings on a game rigged by volatility. Section 4. Counterparty contagion. The most insidious danger of the derivatives market is that it hyperconnects everything. In the old days, if a bank in Ohio failed, it was bad for Ohio, but it didn't threaten the global economy. Today, thanks to derivatives, every major financial institution is tied to every other one in a complex web of mutual dependency. This is called counterparty risk. The risk that the guy on the other side of your bet can't pay up. Let's go back to our OTC example. Bank A bets $1 billion against hedge fund B. Bank A thinks it has a solid asset, a contract worth $1 billion if they are right. They might even use that contract as collateral to borrow more money from Bank C. But what if hedge fund B goes bust? Hedge fund B made bad bets elsewhere and is now insolvent. Suddenly, Bank A's $1 billion asset is worthless. It vanishes into thin air. Now Bank A is in trouble. It can't pay Bank C. Bank C starts panic selling. This is the domino effect. It's financial contagion. The financial system is only as strong as its weakest significant counterparty. We saw a preview of this with Archegos Capital in 2021. A single, relatively unknown family office hedge fund collapsed. It had massive, highly levered derivative positions concentrated in a few stocks. When those stocks dipped, Archegos couldn't meet its margin calls. The banks that acted as its counterparties, Credit Suisse, Nomura, Morgan Stanley, rushed to liquidate Archegos positions. They were scrambling to be the first one out the door. The result was billions of dollars in losses for major global banks. Credit Suisse alone took a $5.5 billion hit, a wound that contributed to its eventual collapse years later. All because one mid-sized player got over-leveraged in the shadow market. Now imagine if instead of Archegos, it was a giant like JP Morgan or Goldman Sachs on the wrong side of a massive derivative trade. There isn't enough capital in the world to absorb that kind of shock. The interconnections are so dense and opaque that no one, not even the CEOs of these banks, truly understands the blast radius of a major failure. They are all standing in a circle, holding hands, on top of a landmine. Trust is the only thing keeping the system functioning. The trust that when I call your bluff, you have the chips to pay. When that trust breaks, liquidity vanishes instantly. And in a levered system, illiquidity is death. Section 5. The central bank illusion. This is perhaps the most frightening element of the current landscape. The widespread belief that if things get really bad, Daddy Fed will save us. The Federal Reserve, the European Central Bank, the Bank of Japan, they are seen as the ultimate backstop, the lenders of last resort. In 2008, they printed trillions to plug the holes. In 2020, they printed trillions more. Markets have been conditioned like Pavlov's dogs to expect a bailout every time they whimper. But there is a mathematical limit to this game, and we are fast approaching it. Think about the scale. The Federal Reserve's balance sheet, after years of unprecedented expansion, is roughly $8 trillion. The derivatives market is $600 trillion. The Fed is a tugboat trying to stop a supertanker that has already lost power. If a true derivatives crisis ignites, the losses could easily run into the tens of trillions in a matter of days. Where does the Fed get that money? They have to print it. But we are already dealing with a stubborn inflation crisis caused by the last round of printing. Central banks are currently trapped in a nightmare scenario. If they print enough money to bail out a derivatives collapse, they will hyperinflate their currencies. Your dollars, euros, and pounds will become worthless confetti. They will save the banks, but destroy the real economy and the middle class in the process. But if they don't print the money, if they let the chips fall where they may to protect the currency, then the banking system collapses. ATMs stop working. Supply chains freeze. Pensions are wiped out. It is the ultimate rock and a hard place. In 2008, inflation was low. They had room to maneuver. Today, inflation is a political and economic time bomb. The public does not have the appetite for another round of bank bailouts that devalues their wages. The central bankers know this. They are terrified. Their tools are blunt instruments. And the problem is surgical. They can flood the system with liquidity, but they cannot force banks to trust each other. They cannot unwrite bad derivative contracts. The illusion of central bank omnipotence is about to be shattered. And when the market realizes the Fed is powerless to stop the avalanche, the panic will be unlike anything we have ever seen. Section 6. The tech accelerant. We don't just have more leverage and more debt than 2008. We have a fundamentally different market structure driven by technology. In the old days, humans made trading decisions. Humans panic. But humans also hesitate. They second-guess. They need to make a phone call. Today, the vast majority of trading volume is driven by algorithms. High-frequency trading firms and quantitative hedge funds use complex mathematical models to execute trades in microseconds. These algorithms are designed to react instantly to market conditions. If price drops below point X, sell Y amount immediately. There is no hesitation, no human emotion, just cold execution. This speed is a massive accelerant in a crisis. When a trigger event happens, thousands of algorithms simultaneously rush for the same exit. They all try to sell at the same time. But who is buying when everyone is selling? Nobody. Prices don't just fall. They gap down into an air pocket. We have seen previews of this. The flash crash of 2010 saw the Dow Jones plunge almost 1,000 points in minutes before recovering. It was a glitch caused by algorithmic interaction. But in a real derivatives crisis, there will be no quick recovery. The algorithms are also heavily involved in the derivatives market itself. They use derivatives to hedge positions and create synthetic leverage. When volatility spikes, these models often require automatic selling of assets to reduce risk. This creates a feedback loop. Volatility triggers selling. Selling creates more volatility, which triggers more selling. It's an automated doomsday machine. Furthermore, the complexity of these derivatives has grown beyond human understanding. They are designed by physicists and mathematicians using models that work perfectly on paper. But these models are based on historical data. They assume that the future will look somewhat like the past. They always underestimate tail risks, the extreme, once-in-a-century events. Nassim Taleb calls these black swans. The $600 trillion market is structured based on the assumption that black swans are incredibly rare. But in a hyper-connected, geopolitically unstable world, black swans are becoming flock animals. When an event occurs that the models didn't predict, like a global pandemic followed by a major European war and a sudden spike in inflation, the models break. They start spitting out nonsensical risk assessments. And the algorithms, following broken models, drive the system over a cliff at the speed of light. The next crash won't play out over months like 2008. The decisive phase could happen in days, or even hours. Section 7. The trigger points. We have a massive, opaque, highly leveraged market built on shaky assumptions and managed by speed-obsessed robots. What sets it off? The terrifying thing is that it could be almost anything. The system is so taut, so stretched to its limits, that a pebble could start a landslide. Let's look at the most likely triggers blinking red right now. First, interest rates. For over a decade since 2008, we lived in a zero-interest rate world. Money was free. This encouraged massive speculation. Why save money at 0% when you can lever up and gamble in derivatives? Trillions of dollars of derivative contracts were written assuming rates would stay low forever. Then came inflation, and central banks were forced to hike rates aggressively. This was the fastest rate hiking cycle in history. Suddenly, the cost of money isn't zero. Suddenly, all those debts and leveraged bets are getting expensive to service. We already saw the first cracks. Silicon Valley Bank, Signature Bank, First Republic. They failed because they held safe assets, government bonds, that lost value when rates rose. They weren't even gambling wildly in derivatives. And they still blew up. Now imagine the impact of these rates on the shadow banking world, where leverage is 100 to 1. The tide is going out, and we are about to see who is swimming naked. Many derivative structures are now underwater, waiting for a margin call they cannot meet. Second trigger, geopolitics and energy. The world is more fractured than at any time since the Cold War. War in Europe. Tensions in the Middle East. A brewing Cold War between the US and China. The derivatives market is heavily exposed to commodities, oil, natural gas, metals. A major geopolitical event, a blockade of the Strait of Hormuz. An escalation in Ukraine that cuts off critical supplies. A conflict over Taiwan could cause commodity prices to move violently overnight. Remember, derivatives are often huge bets on small price movements. A 20% overnight spike in oil prices would obliterate countless hedge funds and trading desks positioned for stability. The counterparty failures would be immediate. Third trigger, the sovereign debt crisis. Governments around the world are drowning in debt. The U.S. national debt is over $34 trillion and climbing rapidly. Japan, Europe, China, they are all in the same boat. The derivatives market is heavily intertwined with government debt bonds. Interest rate swaps, the biggest chunk of the derivatives market, are essentially bets on government borrowing costs. What happens when the market looks at the U.S. debt trajectory and decides it's unsustainable? What happens if there is a failed treasury auction, where nobody wants to buy U.S. debt at current rates? Bond yields would spike dramatically. This would trigger an apocalypse in the interest rate swap market. The banks holding trillions in derivatives tied to stable government bonds would face existential losses. This isn't a hypothetical. The UK got a taste of this in 2022 during the gilt crisis. Pension funds using derivatives were almost wiped out overnight because of a sudden move in British government bonds. The Bank of England had to panic print money to save them. Next time, it might be the U.S. Treasury market. And no one is big enough to bail that out.
Wow.
Let's bring it all together for the climax. The convergence. The nightmare scenario isn't one of these triggers happening in isolation. It's them happening together. Imagine this. Inflation remains sticky, forcing central banks to keep rates higher for longer. Use of leverage becomes more painful by the day.
Then,
A geopolitical black swan hits. An energy crisis spikes oil prices. Simultaneously, a major, overleveraged player in the shadow market, a massive hedge fund you've never heard of, gets caught on the wrong side of the energy trade. They get a margin call for $50 billion. They don't have it. They default. Their prime brokers, the big banks, rush to liquidate their assets. The algorithms see the selling and join in, accelerating the crash. Stock markets plunge. But here is the kicker. Because the hedge fund defaulted, the banks are left holding the bag on trillions in notional derivative contracts. Suddenly, Bank A realizes Bank B is heavily exposed to the fallout. Bank A stops trading with Bank B. The interbank lending market freezes. The news breaks. Panic spreads. To the public. People rush to pull money out of banks. The central banks call an emergency meeting over the weekend. They look at the numbers. The hole in the system is in the tens of trillions. They realize that printing that much money will destroy the currency. But not printing it will destroy the banking system by Monday morning. They stare at each other in the situation room. Realize they have no good options. This is the moment the bomb goes off. The $600 trillion time bomb that was built brick by brick over decades of greed, negligence, and cheap money. 2008 was a heart attack where the patient was revived on the table. The next one will be massive organ failure. The realization will dawn instantly. The assets on bank balance sheets are illusions. They are just digital entries representing bets on bets on bets. And when the music stops, there are no chairs. This is why the next crash will be worse than 2008. In 2008, there was still some cushion. There was still some belief in the system's resilience. Interest rates could still be cut. Governments could still borrow without immediate consequence. Today, those buffers are gone. We used all our ammo fighting the last war and the pandemic. We are entering the greatest financial storm in history naked and unarmed. The complexity of the derivatives market ensures that when it unravels, it won't be a slow bleed. It will be sudden cardiac arrest. The speed of high-frequency trading combined with the opacity of shadow banking means the damage will be done before regulators even open their laptops. Fortunes built over decades will vanish in milliseconds. And the consequences will spill out of the financial sector into the real world with devastating speed. This isn't just about bankers losing their bonuses. When credit freezes, businesses can't make payroll. Container ships get stuck at ports because letters of credit aren't honored. Grocery stores panic about restocking. It's a cascading failure of the just-in-time global economy that depends entirely on the smooth flow of credit. And at the heart of that credit system is the rotting core of derivatives, a parasitic growth that has become larger than the host. What is the final message here? Is this just a counsel of despair? No. It is a call for clarity. The first step in dealing with a problem is admitting it exists and understanding its scope. We are living through the end stages of a massive debt supercycle, fueled and hidden by financial engineering. The powers that be, the politicians, the central bankers, the media giants, have a vested interest in pretending everything is fine. They need you to keep borrowing, keeping spending, keep believing in the illusion of perpetual stability. Because if you stop believing, the whole house of cards tumbles. They will tell you that derivatives manage risk. They will tell you the system is capitalized better than ever. Don't listen to what they say. Watch what they do. Watch them panic every time the market dips a few percentage points. Watch them change the rules whenever they start losing the game. Watch the desperate scramble for real assets, gold, land, resources, by the very elites who tell you paper money is safe. The $600 trillion figure is not a glitch. It is the inevitable feature of a system that abandons sound money and productive investment for financial alchemy. We tried to turn debt into wealth. We tried to print prosperity. We tried to hedge away all risk in a world defined by uncertainty. We failed. The bill is coming due. The derivatives market is the ultimate expression of humanity's hubris in trying to control the uncontrollable. It's a monument to greed. Yes. But also to delusion. The delusion that mathematics could conquer reality. That we could build a perpetual motion machine of money. When this breaks, it will be a painful but necessary correction. A return to reality. Real assets. Real production. Real value will become paramount again. The era of financialization, where the parasite commands more resources than the host, is ending. It will end chaotically because we refuse to end it deliberately. The transition will be brutal for those unprepared, for those holding paper promises in a burning building. But for those who see the bomb for what it is, there is an opportunity. Not an opportunity to get rich quick in the casino. Let the fools play that game. But an opportunity to position yourself, your family, and your community on solid ground. To understand that the volatility ahead is not an anomaly, but the necessary unwinding of decades of artifice. The ticking is getting louder. You can hear it in the erratic swings of the bond market. You can feel it in the persistent inflation eating away at your savings. You can see it in the desperate eyes of central bankers trying to explain away the unexplainable. The $600 trillion time bomb is the defining economic reality of our era. It hangs over every political decision, every geopolitical maneuver, every investment choice. Ignoring it is no longer an option. We are standing at the precipice of a historical shift. The old world, built on debt and derivatives, is dying. The new world has not yet been born. And in the interval, there will be chaos. But there will also be truth. The truth that you cannot print wealth. The truth that risk cannot be destroyed, only transferred and hidden. The truth that an economy unmoored from reality cannot stand forever. The bomb is there, ticking away in the dark servers of the shadow banking system. We don't know exactly when it will detonate. Whatever the trigger, the result is programmed into the code. The question is no longer how to stop it. The question is how to survive what comes after. This battle is not just about numbers on a screen. It's about the future of who controls the resources of this planet. The story is far from over. If you want to keep uncovering the truths they are trying to hide, if you want to be on the right side of the massive wealth transfer that is coming, then do not miss the next video. It's time to wake up. See you in the next video.